Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to the Apartment Gurus, where we dive deep into all things multifamily investing. Our mission is to educate, inspire, and empower real estate investors to reach their highest potential. Each week, host Tate Siemer and co-host Chelsea Garber interview high-level guests from all over the industry who are sure to bring valuable, actionable ideas that will propel your business to the next level. Whether you're just starting out or a seasoned investor, you are in the right place. And now your hosts, the Apartment Gurus, Tate Siemer and Chelsea Garber.
Welcome back, everybody. Another episode of the Apartment Gurus coming at you, formerly the Apartment Guys, and we are in the more. Well, I guess this is really appropriately called the Apartment Gurus because we have a guru on the show today that, you know, if you've been in this space for any length of time and gone to meetup groups and conferences and that sort of thing, chances are you run across Gene Trowbridge, who's our guest today. Really, in the legal space, in terms of the SEC regulations and just staying clean and staying out of trouble. Like, Gene's really a household name, and I've known of you for probably 5 years or so that I've been in the space. I've known of you and Jillian originally, and now you're doing the Trowbridge Law Group, Trowbridge Law Group, and so it's an honor to have you on, sir. I really appreciate you spending some time with us today, and I'm looking forward to the conversation.
Well, thanks for having me, and that was a pretty good introduction. Let me tell you a little bit about myself for the listeners who don't know. I've been in the commercial real estate space my entire career, basically 3 careers: commercial real estate broker. And then I went on to be a syndicator. And as a syndicator, what I did is I built storage facilities. I think we built 32 storage facilities in Southern California. We didn't build them to hold them and operate them. We built them to sell them. Early on, we were selling everything to public storage, and then the business changed. And so there were other operators who came in and bought them. And that was a good run. But business got big, and I was raising money, Tate, through the broker-dealer network, and the broker-dealer network wanted me to even get bigger and bigger, and I had enough.
Okay.
So one of the sayings I have is all the good decisions in life are made around the kitchen table.
Oh, wow, cool. I like that.
I went home one day and sat down with Kay, and we just celebrated our 50th anniversary.
Oh, man, that's awesome. Congratulations. That's
so
excellent.
I sat down with Kay and said, I don't want to grow. I don't want to grow into a bigger business. I don't want more people and more space. And I've got a lot of revenue for the next 6 or 7 years that's going to come in, even if I don't do new deals. So what do you think about if I go to law school? So at 45,
wow,
I went to law school. 2 kids, my wife working, kids in school. I went to law school and got out about 3 years, passed California bar, and immediately opened a law firm to be a securities lawyer.
Mm-hmm.
And that's what I've been. I was going to do it for 15 years, take me from 45 to 60. Well, I'm 75 now. I'm still doing it. And one of my hashtags, Tate, is not retiring.
Not retiring. You love what you do, clearly.
I really do. And as my wife would say, I have no other interests. So what the hell am I going to do?
Right.
I might as well do this. This business is, as far as a lawyer goes, you never go to court. So there's no litigation. There's no anything.
Yep.
We'll have some arguments about the documents periodically, but we can work all those out virtually. So it's a relatively easy business. And so it's good for me, and I intend to keep it up. I have a partner in the business. We have 6 people in our firm, totally virtual. And we'll continue to grow a little bit at a time.
That's excellent. So, I mean, you plan on doing it you said for 15 years, and it sounds like you've done it another 15 years.
That's right. I thought I was going to retire at 60, but this is so good that I'm still doing it. So
yeah, that speaks volumes. And it sounds like you really found your lane, 30 years ago.
Right.
Because you were kind of not exploring, but you had some really great experience in those 2 other roles. And, it sounds like you kind of but you chose the lane of the securities law,
right,
and went after it and became masterful at it. And I think in life, I saw this study about people that have a really high level of career satisfaction. And typically they're people that no matter what they're doing, they've developed a high level of mastery around it. And, there's nothing better than, in my opinion, than doing something and doing it really, really well. Skiing is that for me, quite frankly. I've been skiing hard and heavy for 23 years. And it's the one area of my life that I'm like, this feels really great. I'm pretty proficient at this. And I do this as well as I do anything else. So, and that said, like, since we've been in this commercial multifamily space, the larger scale assets, I really kind of feel the same way about that. Although I certainly don't have the level of mastery yet, but I feel like, as a company, Greenlight and myself, we've really found a great lane to be in, and we don't look anywhere else. Like, in fact, we don't look outside of our 2 markets ever for deals. And, we've got great deal flow in Oklahoma City and Columbus, Ohio, and we've got great broker relationships and property management. So little sidebar there on just getting really good at one thing and doing it really well. And it sounds like you've managed to do that these last 30 years.
Your business is 2 parts. It's managing multifamily properties.
Yeah.
That's important. The other part is, how do you raise the money and how do you manage the investors?
Yeah.
And I believe, when I wrote the first edition of my book a long time ago, I wrote it because I wanted real estate people to understand that putting together a group takes us kind of out of the real estate business and puts us in the management of investors. And I think as a syndicator, you're heavy duty into managing investors. Yep. Yes, there's real estate to be managed. You can find a manager to do that and everything. But, the investors think you have their money, Tate. So you better manage them.
Yep.
With that viewpoint. It doesn't make any difference if you're doing Class C properties or Class A or building or whatever you're doing. The investors have come to you because they want to take part of the opportunities that they think you present.
That's right.
To them. And that's pretty exciting. I have on my YouTube channel, I have a YouTube called Sell the Sizzle. And this is something that someone taught me when I was raising money on how you go about the syndication side, not the real estate side so much. And the first thing they said, you have to build your database with people who understand the sizzle of real estate. It doesn't do you any good to have a blockchain guy in your database. Okay.
Yeah.
You got to sell the sizzle of real estate. And there are a lot of people who can't do real estate on their own, don't have the money, the time, the energy, the ability. So you can find all sorts of people who are into real estate.
Mm-hmm.
Then I think you have to sell the sizzle of what part of the real estate industry have you identified that provides opportunities to you and your investors. Like I said, I did self-storage, you do multifamily, and I would continue to do multifamily today. In the whole world of real estate, there's an imbalance of supply as it has to do with housing, multifamily, mobile home parks, and storage.
Yep.
So I'd stay right in the multifamily industry because of the demand related to the supply. So I want to know, what are the opportunities that I can seize when I do a multifamily syndication, and what are those opportunities that I can share with my investors? Because we're not selling anything.
Yep.
We're taking people in to work with you in your opportunities. And so the third sizzle is, can you sell the sizzle of your team that you've put together, who will work on making sure that the opportunities you've identified are something that they can capture. And then the last thing, and really the most insignificant part of it, is selling the sizzle of the deal. Because if you're talking to people who are into real estate, into multifamily real estate, and understand your business plan and what type of goals you're bringing out, and are in tune with your team and how they're going to capture those opportunities, relatively simple to present them with the offering documents and ask them 2 or 3 questions and just shut up. So I think that's really important. And when I started developing my marketing strategy for investors with that approach, Tate, it was a complete difference. Because what we always do is we grab the offering memorandum when we run out and talk to someone.
Yeah.
Well, does that person even want real estate?
Right.
Some people don't want apartment buildings, even though they want net lease retail. And they don't know who you are anyhow.
Yep.
So if you haven't built that, I consider it's a pyramid: real estate, opportunities, managers, and here's the offering.
Okay.
Smallest part of the pyramid. Make sense?
Totally. And I like how you contextualize, what you're doing. You're not selling, you're not trying to convince or push or force or manipulate anybody to do anything, right? You're just, at the end of the day, you've got this opportunity. If they're in the space and they understand it, likely they'll understand the deal, and you won't really have to sell it. You're just saying, we've got this opportunity, and here's what it looks like. And
Tate, you're supposed to be selling to sophisticated and accredited investors,
right?
And either way, I think the investor should be somewhat sophisticated. What do they know about apartments? How did they educate themselves on the industry of multifamily? And it's not necessarily your job to educate them on multifamily. You can tell them about your deal, but somewhere along the line, there's some education. There's some people out there who are training potential investors on multifamily. There's people who train on mobile home parks, people who train on self-storage, just so the investor knows. That one of the things that bothers me today, Tate, is I do have some sponsors who are leaving multifamily and going toward mobile home parks because of cash flow, simply because of cash flow. And then they go out to their investors who have invested with them before and say, you've got to invest in this mobile home park. Well, what does the investor know about that mobile home park? Are they a sophisticated investor? Mobile home parks. I went to some mobile home park education in the last couple of years from a group that I know pretty well. And they took us by video into a manufacturing plant where they show you how you build coaches. Fascinating. And if you don't know what makes up one of these coaches that you're going to rent and try to manage and everything, you're kind of in trouble. It'd be great if there was someone who took you through a virtual picture of how do you build an apartment house.
Yeah.
That would be great. God, that'd be wonderful for people to know.
Yeah.
Because, they know the numbers, they know the NOI, they know all that stuff, but they don't know how one 2x4 is connected to another 2x4.
Yep. That's a great point. Do you work across all the commercial asset classes or?
No, I could, but I've got to say that 80% of my business is multifamily.
Okay.
And because of my background in storage, that's the second highest. And then mobile home parks. I do very little retail, almost no office,
Okay.
but I do work all across the country. So geographically, I'm not handcuffed because this is federal law. And so we work, I could work in Columbus, I could work in Oklahoma City, in fact, too.
Yeah. Okay.
So that's fine.
That's great. That's great to know. And while we're kind of on that subject, what, for the listener out there that's, looking at doing their first deal or looking at doing, leveling up from that point, what would it look like to reach out to you? How would they do that? And how would they engage with your services?
Okay. Well, probably the best thing to do is just either call us. Now, not everyone is watching this live, but our direct number is 949-570-1507. And our website is TrowbridgeLawGroup.com. That would be the best way to reach out to it. And generally, I would have Tate what I call a homework call. Let's talk about this. One of my best homework calls is when someone calls me and says, I've invested in 15 apartment deals myself, and now I want to be a sponsor. My first response is, why?
Yeah.
This is big business. This is something different. If you're making money as a passive, make money as a passive and go play golf.
Right.
This is, as my book says, it's a whole new business. Okay.
Yeah. And look, that LP position in these deals, I've said this many times on the show, it's a sweet position. It's arguably the best position to have. You get paid first, you get paid the most, you have the most security as far as ownership goes. And, you're not doing anything other than deploying capital and sending a wire in and then watching things happen. So,
no, I think that's true. I think that a lot of people think the sponsor makes a lot of money for what they invest. But, in the old days, people would, one of the questions an investor should ask a sponsor is, do you have skin in the game?
Right.
And in the old days, that just meant cash.
Okay. Yep.
Well, today, sponsors are signing notes, they're signing mortgages, $6, $7, $10 million mortgages.
Yeah, they're signing personal guarantees on.
Yeah, isn't that skin in the game? I think for those people who want to invest in someone else's deal, I have 4 questions that I think they should ask to start with. And I'm just going to pretend that you're the manager and you want me to invest with you. Okay.
Sure.
So Tate, I know you want $50,000 from me, and the investment looks good. I've got the $50,000. I'd like to send it to you, but I just have one question. Tate, what happens if something happens to you?
Great question. Yeah.
And that's the first question. And if Tate doesn't have an answer, that I have a team, that I have continuity, I'd walk away from that deal. In fact, I won't, as a syndication lawyer, do an offering set of documents if the general partner is, or the managing member is an individual. I won't do it because I don't think it's right for the investors. Number 1 question. Number 2 question. Tate, have you done this before?
Yep. Got it.
And Tate, when you started and I started, we had to answer that question. No, we hadn't. But we had other real estate experiences that we could draw on that would get us through the first deal. So you got to get your first deal done so you can answer that question. Hell yes.
Yep.
You got to do that. And number 3, Tate, are you going to have any skin in the game yourself? And that's where you talk about, I'm investing so much, I'm signing a mortgage, I'm totally in the deal. Cool. And the last question the investor should ask, Tate, if something happens to me, can you explain the liquidity provisions, if any, in your documents?
Yep.
Those are the 4 questions. And I haven't used the term NOI, cash on cash. none of that's important unless those 4 questions are answered satisfactorily to whomever the investor is.
Yeah,
What
and
do you
those
think about that?
Those are great questions. And
a sponsor should know. I just said these are the questions an investor should ask, but if an investor is going to ask it, then we sponsors know we better have an answer to all those questions before they're asked, right?
Absolutely. Yep. And I'll be honest, I know that we've got the liquidity provisions and we've got the team, we're a team of 4 generally, and sometimes more partners, but I'm not sure that I could at this point explain the mechanics and logistics behind those provisions, I guess. So that this is a great takeaway for me, to get clear on how we're set up.
Well, Tate, somewhere along the line, an engineer is going to look at your documents and is going to ask you those questions.
Yeah.
I'm not disparaging engineers, but they read every word, and so they want to know the answers.
Yep.
And I think you need to do that. There's nothing that's worse in the world. That's one of the biggest mistakes I think my clients make, is not reading and understanding their documents. Because if an investor says, what's a liquidity provision? And you don't know,
right?
Well, why would I invest with you then?
Yeah. And that's basically all captured in the private placement memorandum,
in the operating agreement, right? It says you can go out and sell your interest, but the existing investors want the first right to buy it.
Yeah.
Okay. And if the investors don't want to buy it, the company can buy it if it has its money. The manager can buy it if it has money. And if we can't keep it inside, we'll go ahead and sell it. Now, selling it is a problem because it's kind of a difficult market to resell securities. So it's more than likely it's going to happen inside the company with investors who know how good a deal it is, or the manager or whatever. I wouldn't know. If I had 200 shares of Coca-Cola to sell, I wouldn't know how to sell it.
Right.
I have to call a broker, right? So it's the same situation.
Yeah. Yeah. This is great stuff, Gene. And, pretty eye-opening to me myself, and hopefully listeners are getting a lot out of this. What do you see, just to shift gears a little bit, that you talked about how important that first deal is to get done, and Michael Blanc calls it the law of the first deal. It's the biggest deal. It's the most important deal you'll ever do because it puts you on the map, and you can change, like Gene said, you can change the answer as far as your experience goes. You can change the answer from no, I've never done this before, to yes, I have. Brokers notice you because you just closed on a deal, and they notice that you're a buyer, and so you may start getting calls or deal flow from them, lenders, et cetera. So in that stage of the game, people doing their first deal, they've got it under contract, they're raising capital for the deal. What are there common mistakes that you see a rookie, I'll just call him a rookie, make in terms of your concerns with securities?
Well, here's what I think. I think in your first deal, you're going to raise money from the people who know you.
Yeah. Period.
And if you're worried about that and you think, well, I need to use social media or something like that, then you're not ready. When I tell people, I give them a 10-step approach. One of the steps is to have a database of at least 50 investors that you think you have a 50-50 chance of getting $25,000 from each investor. And so that'll give you $1.25 million. And I think if you go out and do your first deal where you don't have to raise more than $2 million, you've got a great chance of success. But don't think you're going to go to the marketplace with no track record and no knowledge on your first deal and raise any money. Yeah. I think another thing that we need to know, especially in today's financing world, where lenders are changing their mind every day.
Yeah, tell me about it.
Yeah, don't put a 45-day escrow in your deal. If you can get, 60 was always what I thought, even through the last great time period we've had, but right now you might want 60 plus an option to extend another 15 or start with 75. It's going to take longer than you think.
Mm-hmm.
That would be, and pressuring it is a bad deal. Here's one thing I found, Tate, that I made a mistake on when I was syndicating.
Mm.
And I'll build the watch a little bit. When you're a syndicator, that's your business, right?
Mm-hmm.
So when you're out selling deals, you're making money.
Mm-hmm.
You, in between deals, when you're just managing, you can make some money too, but you really need to be out there. And when I was out there, I was doing my offerings where the broker dealer network was raising my money for me. So when I had a product on the street, I had all these broker dealers looking at it and selling. But when I didn't have a product on the street, my fear was the broker dealers who were looking for a product found someone else's product.
Mm.
And I wonder if they'd ever come back to me.
Mm.
So one of the mistakes that I made was putting a deal out on the street too soon.
Okay. That makes sense.
Before I was ready, before the deal was ready.
Mm-hmm.
And you can't do that. The deal has to be ready. If it takes you 6 months, it takes you 6 months. Your investors will either wait for you or they won't. And there's all sorts of things you can do in the middle to build your database. But thinking you always have to have a product on the street, Tate, I think that's a mistake.
Yeah. And you hear a lot of gurus in this space talk about you're raising capital, whether you have a deal on the plate or not. And, that a lot of people advise that that's what you start with in this business. And, I'll be transparent. We were a deal first company when we attacked this space. And, and I still kind of think there's something to having something live to offer somebody, and just if for no other reason, just say, this is a deal we're doing right now. There happens to be an opportunity here, but I, mainly want to just see if this is something that you'd be generally interested in if I brought you something like this.
Yeah.
And it just gives it the conversation a little different twist if there happens to be the opportunity there for them to take advantage of. But quite frankly, raising capital was like second in line to getting deals. And 2 years ago or 3 years ago, when we were really getting into this deals, it was very competitive, and it has stayed competitive. So we put all our efforts into getting these deals under contract and getting to the finish line. Well, guess what? Part of getting to the finish line is raising your equity.
Right.
And so, the more you have in place with your CRM, your database, your automated emails, your landing page, your click magnets, like that's all really powerful stuff to
because you're always building your database.
Yeah.
Whether you have a product or not, just build your database. I think since about 2012, which is what I think this cycle is that we've been in almost 10 years now.
Yeah.
There's more money than there is product.
Yeah.
I work with a number of large groups and do a lot of their legal work for their individual leads. And I can't tell you how far I have to go back in my memory to find a deal that someone didn't fill up.
Wow.
They had to cancel because there wasn't any money. That just hasn't been the case.
Yeah.
And, I've been through the industry. I am not a rookie here.
Yeah.
I'm 75 years old, so I've been through 78 and 81 and 86, the worst, 94, 2008. I've been through all of them. And my feeling is people still need housing.
Yep.
This is where you want to stay. And people still have money to invest.
Mm-hmm.
So you want to give them an opportunity to invest where there are opportunities, and they can make some money. I'm still of the opinion that there's more money out there than there are products. I am a little worried, and when guys tell me I'm in 20 passive deals, okay, how liquid are you? do you have enough money for the 21st? Or don't we need some of these guys to sell to give you money back so you can go forward? I don't know that. And it's possible that a lot of investors are fully invested because they've been buying so many things. But I don't know, the market, I haven't seen any change. During the 3 years of COVID, our business grew every year, Tate.
Yeah.
And this year through July, we're 20% ahead of last year. And last year was our biggest year ever.
Wow. That's awesome. You're doing things right, but it is a reflection on somewhat on the market as well. And
sure.
I mean, there is obviously there's tons of capital out there and that needs yield, it needs a place to go find yield. And people want to mitigate risk as much as they can. And, I've shared this on a few episodes recently, but our formula is pretty basic. Like we're buying properties that we know we're going to want to keep for at least 5 years. We're sourcing fixed interest rate debt, longer term debt, and we're buying properties that are basically, keeping up with the market and riding the wave from inflation. But I mean, more importantly, Gene's point about your point, Gene, about the demand factor. That's a real thing. And depending on who you listen to, we're tens of thousands, hundreds of thousands of units short as we sit right now.
Households keep getting formed much faster than housing units become available. There's no question about that. So you have to think, you mentioned financing. There's been a lot of bridge loans in the last couple of years where people get aggressively, they get 5 years with 2 1-year extension.
Yeah.
Well, or 3 years and 2 1-year extension. And I have to write in the offering document that, this lender is not going to refinance this property.
Mm-hmm.
We're going to have to go somewhere else to get a new loan. And the risk is 5 years from now, rents haven't gone up, but cap rates have.
Yeah.
Can we really refinance the property for the existing loan?
Yeah.
And this lender is the last person in the world who is going to refinance this loan for you.
Yeah. Yeah.
So in fact, good lenders, and I know a little bit about this, good lenders underwrite properties right now twice. They underwrite acquisition, and then they look to 5 years and they say, okay, what do we think the rents will be? What do we think the cap rate will be? What do you think the lending terms will be? And is this property 5 years from now refinanceable? And if it isn't, they won't make the loan.
Yeah. Specific to rent growth, if you don't mind, Gene, grabbing your crystal ball for a minute, what do you have? It might not be a fair question to ask you to predict, but it seems to me like rents got to grow through this cycle, really, no matter what, because you've got inflation, you've got supply and demand, like you've got markets that are already in heavy growth mode. Do you have any thoughts on what we might see?
I'm not really active in that part of the market, the underwriting of the properties, but I do have one golden comment.
Okay.
They're going to go up.
Yeah.
Like I said, I've been around for a very, very long time, and you want to ask me when rents went down?
Right. Yeah, exactly. Like never. Right. Yeah. Yeah.
So,
If they may soften, the growth may soften and maybe even get kind of flat, but for a bit, but the value of real estate really never goes down. Rents never really go down. Cap rates go up with interest rates.
Down, right. But if you've underwritten your property right now at current rents, current loan information, what's the problem if everything stays the same?
Yeah.
Yep. Yeah, you might not see the appreciation you want. Maybe that's what your investors want. Maybe they want current cash flow. It doesn't. But if it's underwritten right, why can't it just work for 3 or 4 years with no changes at all?
Yeah, exactly. And that was the point I was kind of getting at it. We're planning on holding everything for 5 years and keeping things in cash flow mode. We buy in the two markets we're in because we can still buy for cash flow, and they're growth markets. They're not as heavy growth market as like an Austin or, the Carolinas or Southeast Nashville, but they're still growth markets. The population's growing. The single family supply is under heavy demand, and that's always telling when it comes to apartments, in my opinion. So yeah, I love your prediction. That's a great one. So, okay, cool. As far as, 506B, 506C stuff and the SEC, do you see the rookies or the novices? Do you see any common mistakes that they're making?
506B. The SEC reported that in the last 12 months that they ran the numbers, and this would all be by looking at Form Ds that they get.
Yep.
Private placements, Regulation D, was a $2 trillion market. And that's more than the IPO market on Wall Street during the same period of time. And 95% of the money is raised in 506Bs.
Okay.
Now we got to kind of unravel that. $2 trillion is not real estate. We might have 500 million in real estate. It might be a quarter of it in real estate, but 95% in 506B. Why is that? It's because the broker dealer community that has these huge databases of people that they know and they have a pre-existing relationship. They don't need to advertise. They just go into the Rolodex and sell their stuff.
Yeah.
My most prolific syndicator, I've done 164 deals with them since 2014, and they're all between 7 and 10 million. He doesn't advertise. He only takes accredited investors, and he has a network of about 15 deal sponsors. Typically, he finds a deal sponsor who has a deal who's short $7-10 million of putting together right now, and probably will be short that money for 2 or 3 years. And my client steps in, funds that, takes control, and then in 2 or 3 years, the property gets refinanced, and we go forward. But he doesn't need any new investors. He just probably has a yellow pad. And okay, who's going to throw 50? Who's going to throw 100? He knows all this. So there's nothing really to do. In the 506C offerings, that's questionable. That's for people who have a track record.
Okay. Yep.
If you don't have a track record, you're making a mistake trying that.
Got it.
From a marketing standpoint, you can do it legally, but from a marketing standpoint, you're making a mistake.
Yep. Totally makes sense. We're in the 506C space at this point, and likely to stay there. And this is a slightly different subject, but we're one of our capital raises right now is over $12 million. So we're going to institutions, family offices, and starting relationships there. We're dealing with brokers that have relationships with those sources. And that's kind of becoming our world. Now, we always have our own stack that we need to cover on these deals. And we do that under 506C. But do you see a lot with your client base? Are most of them just raising their own LP capital, or do you see?
Oh, yes. No.
Yeah.
I advise strongly against hiring anyone else to raise capital for you. I could go at length why I think that is wrong, but your listeners aren't. They're not interested in that.
Okay.
But I would strongly suggest you don't do that. Now, I say that when I was a syndicator, I raised all my money through the broker-dealer community.
Okay,
I didn't raise any of it myself. My job was wholesaling to stockbroker B and stockbroker C. What investors do you have who might want this deal? But they knew the investors. I didn't know the investors. That world is over. With the advent of REITs, those people are going to put their clients in REITs that have liquidity, not in a 5, 6, 7 year hold, because they want to turn the money. Their investors want to be able to turn the money. So it just doesn't work.
Okay. So if you had a client that, had, in our case, 8 deals under their belt and needed to raise 12 million, what would, your typical?
Well, I'd go 506. I mean, it would be a specific offering, and I'd go 506 because you're out there hammering everyone with your track record.
Yeah. So 506C is what you would do there.
Yeah. And you've got all sorts of investors in your database who are accredited.
Yeah.
They can invest in 506C. The rule now is if you take an investor from your database and put them in a 506C and they go through the third party verification, you can take them in the next couple deals you have for 5 years and you don't have to verify them again.
Yep.
Just one verification. Well, that really opens up things. And a lot of people, like my client that I alluded to, all accredited investors, they would never stand still going through a third-party verification after, 8 or 9 years investing with him. They'd never do that.
Got it. Okay. Gene, what topic have we not discussed today or what question have I not asked that you consider to be important for us to touch on? Anything?
Oh, I don't know. The last podcast I was on, the guy wanted to know what my favorite food was. So,
okay.
So I have no idea. I have no idea. No,
what is your favorite food?
It's Italian.
Okay, got it. Perfect.
Second, very closely is Mexican food. In fact, we're recording this on a Tuesday, and when I get home, my wife and I are going out to Taco Tuesday. So
nice.
Have a margarita and a couple tacos.
Perfect.
I think we've actually covered an awful lot.
Yeah.
If in fact there are any things you wanted to dig into deeper or that we didn't cover after you look at that, I can always come back. #not retiring. I could always come back if you wanted.
Okay. Well, it would be an honor to have you back. We really appreciate, I really appreciate you and your level of experience and wisdom and your ability to communicate it all very clearly and in a way that is very understandable, I think, to everybody. I hopefully listeners, hopefully you're taking notes, you were really engaged, maybe taking mental notes and getting these takeaways. I wanted to bring up for myself and for you guys, I wanted to bring up the common mistakes thing as much as anything with Gene, because he's seen so many deals, so much business, so many equity sources and investors. And, I can't think of anybody that comes close to the level of, years, experience, deals, et cetera, that Gene has. So, I've got a high level of gratitude for this, and we will definitely take you up on the coming back maybe in a year or two and talk about the shifts that have occurred since then.
Sure.
Yeah.
Don't lose my number. Don't lose my email. Okay.
Yeah. Yeah. So listeners, again, let's do that. So Gene's firm's phone number is 949-570-1507. And the website is Trowbridge Law Group. So Trowbridge is TROWBRIDGE lawgroup.com. And then on YouTube, it's Trowbridge Law.
We've got a great YouTube channel with all sorts of education and interviews of syndicators and everything. So I get a lot of comments on that. Okay.
Yeah, I bet YouTube University is a real thing. You can learn an awful lot. So, sir, thank you. Really appreciate it. And, go have a great Taco Tuesday with the wife. Perfect.
Thank you very much.
You're welcome. Thank you. And listeners, thank you for listening to another episode of the Apartment Gurus. And we'll see or hear you in a couple of days. We're putting out 2 a week now. So try to keep up, high level guests like this. it's a privilege, really. So, Gene, thanks again, and listeners, thank you, and we'll see you on the next one.
Thanks for listening to the Apartment Gurus with Tate Siemer. Tate and Chelsea are grateful to have you as a loyal listener. If you like what you've heard, please subscribe, rate, and review, and share with friends on your Apple Podcasts, Google Play, Spotify, or any other podcast platform. Also, check out Tate's YouTube channel for videos of many of these episodes and more. Until next time, take massive action steps and rock on.